Good morning, good afternoon, good evening, everyone. I'm very pleased to welcome you all to our first Legerity live event. We will discuss today IFRS 17 and some of the questions you have. So, as you all know, the IFRS 17 deadline is fast approaching, and many companies have now started implementing a solution to comply with this new regulation. However, there's still many questions and concerns in the industry. The objective of today's live event is to answer those questions and maybe giving you some good advice to help you on your journey toward IFRS 17 compliance. I'm joined today by Mark Miller, our global expert on IFRS 17, to answer your question here in live. Hi, Mark. How are you doing?
Hi.
Ready to answer the question?
Yep. All ready? Yep.
Perfect. So as a reminder, you can ask all your questions in the comment section or drop us an email at info@legerityfinancials.com. We will do our very best to answer all your questions, and if we don't have the time to answer them during this session, we'll make sure to come back to you via email or address them in our future events. So let's start. Here's the first question from our last webinar, actually. Mark, the first question is from an actuarial manager from an insurance company in the Middle East. He's asking the following question. From an actuarial point of view, is it preferable to start from cash flow or from the output of the IFRS 17 engine of the actuarial software?
Okay, yeah, good question. So I think this was something that was thought about a lot early on in the IFRS 17 journey, where the actuaries realized that a lot of IFRS 17 is underpinned by actuarial cash flow modeling. So it's a kind of natural extension from that to produce the BEL or the fulfillment cash flows, and then you have your CSM. So that's an obvious initial conclusion, but the point is IFRS 17 is actually an accounting standard, and there are a lot of detailed disclosures that are required. You need to track the movements of balances across many different dimensions. So ultimately, being a finance standard, you need to create a transactional style view to underpin all these movements. And that's where there's more of a conflict with the modeling view. So you can run your models in a step-by-step way and get all of the outputs that you need, but then we need to account for those in a granular way. So both options are valid, but I think the transactional nature of IFRS 17 would push me more to be thinking the solution should contain a strong financial element and be supported by sort of transactional style tools.
Okay, that's very interesting. Actually, that brings me to the next question, which is, from an actuarial point of view, is it preferable to start from cash flow or from the output of the IFRS? How to bridge the gap between the point of view of modeling to support IFRS 17 and the accounting and the disclosure aspect?
Yeah, no, I think this is building on the last point quite well, this question. So the issue with models is it's tempting to run your model once and then to overlay a number of different assumptions, and then you get the next point of view from the model. So that's a natural way of working from a modeling perspective. But as I mentioned in IFRS 17, we've got to identify very specifically different accounting movements, and they need to be accounted and disclosed separately. So in terms of bridging the gap, I think what we're looking at is a way of running the model, a workflow where you're looking at running it in a step-by-step way. So you have to isolate the impact of certain changes in the model and then obviously account for those. And that's the integration of a finance accounting solution and actuarial modeling is probably the ideal solution, with the modeling being produced in a very strict step-by-step way, and the accounting solution can help define how those steps need to run.
Okay, very, very interesting. Thank you very much, Mark. So our next question is around what challenges arise from situation where acquisition cash flow occur before the start of an IFRS 17 group?
Yeah. So, it's all very well writing a nice accounting standard, but then when it clashes with the real world, a number of challenges can arise, and not least this one with acquisition cash flow. So, I think there's a few things. One, in the real world, you could well be paying amounts to your channel before the IFRS 17 groups start. So that is one difficulty. And then the other one is that the standard does allow you to allocate acquisition cash flows to future groups. So the amount that you pay your channel, for acquiring a customer for that initial contract isn't necessarily going to be just for that contract. So you can deem some of those amounts to be for future contracts, so when the customer renews their contract. So this means in both these cases, we have cash flows that need to be recognized in the financials, but at that stage you don't necessarily have an IFRS 17 group to allocate them to. So that's the first challenge. And then, of course, the second challenge is, if you are going to book your acquisition cash flows on the balance sheet, you have an asset there. You need to make sure it's a valid financial asset, so you need to test for impairment. And then when we're considering future groups, you have to look at how are you going to identify what part of the acquisition asset is going to be allocated to which future group. And for that, you need to understand obviously the performance of your customers and how often they renew. But once you have that amount, there's a mechanical calculation that's needed for actually allocating those amounts to the correct groups as and when they start.
Amazing. And how can this be managed?
Yeah, so I think the first thing I would say is when you book your acquisition costs, it's preferable to create a specific group for those. So although they'll be on the balance sheet as a standard transaction, we recommend allocating them to a higher level group in the financials so they can be identified and tracked separately. And then you need specific accounting events to pull out the relevant aspect of those acquisition costs into the IFRS 17 group as that group starts, as its coverage commences, basically. And to support that, you could well benefit from an allocation engine, so that the parameters that you use to allocate the actual amounts, you can automate that calculation via an allocation type tool. And then you need accounting transactions around impairment and the amortization of the acquisition costs within the group. So there's quite a lot going on in that space. But yeah, having higher level aggregation groups and the ability to allocate when the IFRS 17 group starts is probably the foundation of it.
Perfect. Thank you very much. So the next question is coming from our email. It's a question from another Mark. There are a number of aspects associated with onerous contracts group. What particular challenge do insurers need to watch out for?
Yeah, so this comes back to it's easy to measure your fulfillment cash flows and then talk about recognizing the CSM. But of course, some groups are onerous and therefore there isn't a CSM and therefore you have to recognize a loss. So you need to be able to account in different ways depending on if a group is onerous or not. So that's a challenge. So we need some sort of flexibility, some contingent accounting, and it's much more than just one transaction on initial recognition, because a group can become onerous or an onerous group can become profitable. So you need to be able to monitor as you are going along whether your group in question is onerous or not, and the accounting changes. And as with a lot of things in IFRS 17, it's much more complex than it might initially look because of the disclosure requirements. So the disclosure requirements mean that we need to disclose our loss component, we need to track all the movements of the loss component, and we're identifying the movements in our fulfillment cash flows, including and excluding the loss component. So you need to be able to account for all of the movements in your insurance liability, taking into account some cases where it's onerous and some cases where it's not onerous, and being able to divert your accounting into the different accounts accordingly. And then obviously having this automated ability to constantly test whether the changes in assumptions or any of the experience adjustments have actually resulted in a switch of the group from profitable to onerous. And then the loss itself is not actually a real balance in the system. So if you think about, naturally, accountants would identify that a loss in the profit and loss account is where your revenues are less than your costs. So it's not so much an actual figure, it's something that is a result of a mathematical equation, revenue minus cost. So by booking a loss in the P&L, we kind of upset that normal way of having the profit and loss account. So the loss has to be unwound over time, such that by the end of the insurance group, our revenue and our costs create the loss, and there's no particular loss line in the profit and loss account. So that creates an additional challenge. The standard just says we need to unwind on a systematic basis. So we need to look at the way our fulfillment cash flows unwind over time and have calculations that can apply that to the loss in a systematic way. So those calculations need to be in place in your solution, and of course that means that you need to be able to track what the loss is. And traditionally, in the P&L, once you've rolled over to the next financial year, you don't have any balances in the profit and loss account. So we recommend using a technical account to make sure that you have a clear view of the loss and all its movements as you go along, to create that control and of course help you manage the disclosures.
Okay, so would it be possible to just expand a little bit more how this can be addressed?
Yeah, so I think obviously the IFRS17 standard tells you that you need separate groups. So we need to track our onerous groups separate from our profitable groups. So, we need flags that help the system do the accounting to identify if a group is onerous or not on initial recognition. But much more than that, you need a dynamic set of accounting rules. So you need the ability to tag and flag the group such that you're always aware of, is the group onerous or has it become profitable, so that the accounting rules that you set up in your system can do the necessary accounting. And of course, the other real thing is that, getting back to that earlier point, all these transactions need to be very granular. So you need to be able to account at a granular level and identify all of these different aspects individually. So the impact of initial recognition, the impact of unwinding your insurance finance expenses, the impacts of changes in assumptions, the impact of experience adjustments, all these things you need to be able to clearly identify separately, and then have a handle at that exact moment in your solution, is this group onerous or not, and direct the accounting in the correct way accordingly.
Okay, very, very good. Actually, that brings to the next question we receive, also around the groups. What are the options to assign policies to the different IFRS 17 groups?
Yeah, it's a good question, actually. So I suppose the three options are really, you do it upstream in your data environment. So early on, all the policies are classified as belonging to which group. It can form part of the actuarial modeling process. So the actuarial models could assign the groups, or you could do it in the finance accounting system at further up the line. So they're probably all valid. I think the trade-off is, if you do it in the accounting system, you get a very good audit trail of that. The discipline of accounting finance solutions allow you to clearly monitor and see how the policies have been assigned. But that kind of calculation is a little bit mathematical in nature. And I suppose if you think about, can you realistically measure the profitability of an individual policy when projections for that policy would probably normally take into account groups of policies? So I think there's a question over the validity of mathematically assessing if a policy is profitable or not based on the IFRS 17 projections. There's also a sort of workflow question, I suppose, because if you do it in the subledger, then you have a flow back to your actuarial and data environments with the results of that. So that's perfectly possible, but it creates an additional workflow step in your process. If you do it upstream, then that is maybe neater from a workflow perspective. And what you would need there is to consider, when the business cases are launched for various products, can you assess at that stage that particular lines of business or different segments would naturally be expected to be onerous or not. And then similarly with the actuarial model, that kind of sits a bit in between those two areas. But at the end of the day, the actuarial model does require the grouping, because you have to model your cash flows at the level of the IFRS 17 groups in order to get your IFRS 17 financials. So at the end of the day, the modeling, the actual grouping themselves need to end up in the actuarial model and support all the actuarial processes. So in Legerity, we do see all options being taken up by insurers. So I think it's a case of looking very specifically at your own architecture, your own processes, and your own business. In fact, some lines of business would be easy to assess commercially, and others may be more likely to want to assess mathematically in, say, a subledger type solution.
Amazing. Just to remind your audience, we already received a few very good questions, but don't hesitate to write your question in the comment section on LinkedIn or on YouTube, or you can also drop us an email on info@legerityfinancials.com. I just want to expand a little bit more on that. For you, what is the best way to do this grouping and assigning the policies to the different groups?
I think, to be honest, there's no best answer here. I think, if you're not sure, then you need to make sure your overall solution has some flexibility in this regard. As I said, I think it depends for me on the products in question, and it depends on the insurer themselves, because some products would naturally lend themselves to be identified as onerous or not early on in, say, the business case phase, in which case you can run it from the start. Others, you might want to actually perform more of the mathematical style calculation. There are pros and cons of each. So I'm going to sit on the fence and not say that there's a best answer, but certainly, it's good to make sure that your overall solution can handle both options, I would suggest.
Okay, very good. Thank you. Now it's a question that we received about actually some of the new changes or the latest changes around reinsurance and onerous contract. Now that the rules for reinsurance contract with underlying onerous contract have been finalized, what are the challenges we're facing?
Yeah, so this has been something that's been discussed a lot during the IFRS 17 journey we've been on. So it's good to know that the rules are now clear. And I think the IASB has taken on board a lot of feedback from the industry and, allowed insurers to recognise gains within the reinsurance group on underlying onerous contracts. So that's good from a sort of financial management perspective, but I think it does create significant challenges in terms of the IFRS 17 solution. So firstly, you're going to need very clear mappings between the groups, the underlying insurance groups and the reinsurance groups. And that is far from obvious. So depending on your reinsurance arrangements, that can be quite complex. In the final wording of the standard, you're allowed to recognise gains on initial recognition and on subsequent measurement for all types of reinsurance. So assessing the impact on the reinsurance from the underlying contracts and the losses thereof, that can be a significant challenge. And then you're thinking about the accounting. The accounting for the reinsurance is being driven from numbers that sit in the underlying group. So you've got a kind of slightly difficult situation, because normally you would account for, a contract in the the boundaries of that contract. But in this case, the reinsurance has to link back to the underlying insurance contract. So in your solution, you need to be able to do that. You need to be able to read balances and draw information from underlying groups for accounting in the reinsurance groups. And these calculations are quite complex. We've got to recognize our gains. We then have to unwind and deal with those gains as the contract evolves and deal with changes in assumptions. So like with everything under IFRS 17, you need to be able to manage these in quite a lot of granular detail.
Wonderful. And so what insurers could do to prepare themselves on that?
I think the biggest thing is to make sure you've got a very good handle on your reinsurance arrangements and how they link between the underlying insurance IFRS 17 groups and the reinsurance themselves, and have a think about how you assess the recoverability of claims across the different types of reinsurance. So in proportionate reinsurance, that's maybe not so difficult, but in other forms of reinsurance, excessive loss, things like that can be more complex. And with these sorts of things as well, the standard isn't 100% prescriptive, I would say. So there's some optionality. So think carefully about levels of materiality and make sure you've got a good handle on your accounting policies as early as you can in this area. And if you're thinking about your solution, it's not a particularly easy area. So be confident that whoever you're working with has a good and workable approach to this in the solution.
Wonderful. I think we have the time for one last question. Are you okay to take on the last question?
Yeah, sure.
Perfect. So we're not sure yet if we require OCI disaggregation. Can we start a project, or do we need to define our accounting policies first?
Well, I think you need to get moving. The deadline for IFRS 17 is fast approaching, so definitely start the project. There's no need to be clear on OCI disaggregation at this stage if you haven't started. And to be honest, you may well, have your business could well evolve in the future. Your accounting policies can evolve, your financial goals can evolve. So you need a solution that allows you to disaggregate or not, year by year. You need to be able to have the change. You need to be able to process changes. So you need to look at a solution that has flexible OCI disaggregation rules. And that means, again, at a granular level, being able to take the choice for different policy groups, will they be disaggregated or not, and being able to track all of those movements at a granular level. So flexible, dynamic, and granular accounting solution is what you need, but please get started on your IFRS 17 journey.
And that's actually the thing is that if they start, how should they handle this?
Yeah, so you need to have flexible accounting rules, basically. So you need to be able to define your accounting rules in such a way that as the OCI disaggregation choice is made, the accounting can go in a different direction. So, if you're able to define that within the solution at, say, portfolio or policy group level, and the solution can then automatically check what is the decision for that particular group or portfolio and direct the accounting accordingly. So you need to make sure it's automated, but users have the flexibility to go in and make that change for themselves. You don't want to be phoning IT saying we've launched a new product. Can you spend a 3-month project uncoding our previous choice to a new one? So it needs to be flexible, user definable, dynamic configuration.
Wonderful. Thank you very much, Mark. And that's actually a great way for us to conclude today's Meet the Expert live session. And maybe remind the audience about Legerity fast post. Legerity, we developed our IFRS 17 solution based on 3 principles: enterprise-grade functionalities, out-of-the-box configuration, and flexibility, as you mentioned, the important for people to be doing changes themselves and handling a lot of the configuration with pre-packaged out-of-the-box capabilities, as well as fast-track implementation. We believe that tackling IFRS 17 in the right way will help you streamline and de-risk to deliver transformational benefits that will go actually far beyond IFRS 17. Life doesn't stop at IFRS 17. What is going to happen next? If you're interested in hearing a little bit more about Legerity, I really invite you to drop us an email at info@legerityfinancials.com, or simply go on our website and click on the book a meeting button to schedule a call with our IFRS 17 SMEs. And finally, I would invite you to follow us on LinkedIn so you can get notification for those live events, webinars, and other IFRS 17 material. On that note, I want to wish you a very good rest of the week and all the best for your IFRS 17 journey. Thank you very much and have a good day.
Bye.
IFRS 17 is complicated and brings a big change in global accounting standards. As an insurer, you will have lots of vendors trying to get your attention. Our approach at Legerity is different. It's based on decades of experience in accounting rule software and delivering IFRS 17 projects for some of the world's leading firms. Fast Post Express does exactly what it says. It's everything you need to be IFRS 17 compliant, quickly, with no fuss, and will set you up for the future, whatever that might bring. Other solutions can be heavy, complicated, and often designed for other purposes, even other industries. All the stuff that just weighs you down. Some are positioned as light, but are full of empty promises. In fact, you actually end up spending more time, money, and effort than you were led to believe. And if you're tempted to solve in-house, you will find out the hard way that IFRS 17 isn't a problem you can tackle with spreadsheets. So why compromise? With Legerity's Fast Post Express, you get an enterprise-grade IFRS 17 solution, pre-configured and SaaS delivered from a team with a track record of success. You benefit from a reduced implementation time, complexity, and expense, giving you regulatory peace of mind and a clear path beyond compliance. Insurance is about managing risk. Choosing your IFRS 17 solution shouldn't be one of them. Legerity. It's our business to take care of yours.